Popular ETFs like the S&P 500 have now officially entered correction territory, falling as much as 12.8% over the past month, partly due to fears the US economy could be facing a recession in the not too distant future. Even globally diversified all-world ETFs are currently down almost 10% from their all-time highs in euros, leading a growing number of investors to start panicking. The thing is, as Europeans, we're currently facing a double whammy. First, not only is the market down, but US stocks have been hit particularly hard, and these currently make up a large percentage of world ETFs, 62% of the FTSE All-World and 71% of the MSCI World. And second, the euro has gained around 6% in value against the dollar last month alone, further driving down the value of American stocks both individually as well as within ETFs in euro terms. As a result, our returns as European investors have been hit particularly hard. Yes, this includes me as well. My wife and I are down significantly over the past month. We'll take a closer look in a second and see where we currently stand in actual numbers. We also need to discuss what's causing this sell-off in American stocks and if it's likely to get worse. Does euro hedging make sense with ETFs as a European? And is getting out of the market right now a good idea as a long-term investor? Let's get right into it. Starting with where the ETF portfolio I share with my wife now stands. We are currently down 7.3% since the start of the year and as much as 9.7% or minus 45,800 euros over the past month alone. So we're basically down a nice yearly salary right there. Ouch. Now, since we started investing in 2017, we're still up 100,500 euros overall, but our average rate of return has dropped a bit, to an average of 10.11% per year. I know many of you watching haven't been investing nearly that long yet though. And since the market has dropped so severely in such a short amount of time, I completely understand if you're freaking out right now. You might even be experiencing the first correction in your investment career, after feeling like the market only goes up from 2023 to mid-February 2025. Not only that, you may feel that this time is indeed different and that it will never recover because you don't like the new US president and thus feel like selling, or perhaps you already sold some ETF shares. Heck, maybe you moved your money to European stocks, or even European defense stocks, which are currently all the rage on Reddit. I discussed if this is likely to be a good idea in last week's video, so make sure you check that out afterwards if you haven't seen it yet. All of this is of course up to you, and I'm not here to judge anyone's decision, but let's try to put the current situation into perspective, so that you don't end up making decisions you may later regret purely based on emotions you may be feeling right now. Here are the monthly returns of a global FTSE All-World ETF in euros. The last time we saw a similar correction was in 2022, while the COVID crash in February to March 2020 was a lot worse. We also saw a similar sell-off in December 2018 and other particularly ugly months in January 2016 and August 2015. And if we look at the S&P 500 index specifically, it historically recorded a 5% pullback as often as 3 times a year, a 10% correction once every 16 months, and drops of 20% or more every 7 years on average. So if we just look at the current market correction through that lens, this is nothing out of the ordinary. However, what seems to be different this time is that it looks as if the US administration has been actively working towards a US market correction, likely for one primary reason. It needs to refinance $9.2 trillion of debt this year. And a recession or an increasing likelihood of a recession would all but guarantee a lower interest rate on US bonds. In fact, we can see that this strategy has already been working, with the 10-year note yield falling 60 basis points in just 6 weeks. And dealing with the US debt crisis is urgent, with 70% of the $9.2 trillion in debt needing to be refinanced in the first half of this year, and because the US is currently spending close to 5% of its GDP on interest payments alone. So there could be more pain, especially for US stocks, or we could be nearing the bottom. There's really no way to know for sure. If they drop further, the percentage share of US stocks in global ETFs like the FTSE All-World will automatically decrease from its current level of 62% if other regions perform better. This share is not set in stone, by the way. It simply reflects the market cap of each country's stocks, and it changes on its own as each of the thousands of stocks in the index become more or less valuable. I just quickly wanted to mention this since I received a few questions about it. Now, you may be worried about the US dollar as well, seeing as the euro gained around 6% in value against the dollar over the past 30 days alone, which is in fact not that different to what happened during Trump's first year in office in 2017, when the euro gained 12% in value against the US dollar. So this could very well continue. I wouldn't be surprised to see the euro-USD exchange rate back at 1.15 or even 1.2 within the next 12 months, which would be a 5 to 10% difference from current levels. As a result, you may be considering euro hedged ETFs, instead of the normal unhedged versions. However, when comparing the performance of world ETFs, you'll quickly realize that hedging does not pay off in the vast majority of cases, especially if you're investing long term. For example, here's the iShares Core MSCI World in its euro hedged version on the left with an expense ratio of 0.3% and its normal version on the right with an expense ratio of 0.2% per year. Now, based on the cost difference of only 0.1% per year, you probably assume the performance is going to be almost identical, right? Sadly, that's not the case. Even if you look at the returns in US dollars to eliminate the difference in exchange rates over this period, from June 2019 to early March 2025, the returns of the euro hedged version were 27% lower at 70 compared to 97%. So unless you're absolutely certain the euro is going to significantly outperform the US dollar throughout your entire holding period, something I certainly wouldn't bet on given all of our own problems in the eurozone, then picking a euro hedged world ETF is likely to lead to worse returns long term. Speaking of that, you can find my favorite low-cost brokers in Europe for ETFs down below in the description, which is a great way to support me as I don't do sponsors on this channel. So, with all this uncertainty, what should long-term investors actually do right now? If you're investing for the long run and you don't need your money within the next few years, the best course of action based on historical data is likely to do nothing, or better yet, to just continue investing according to your strategy. Remember the Mr. Market analogy from Benjamin Graham? Every day Mr. Market knocks on your door offering to buy your assets at different prices. Some days he's optimistic and the offer is high. Other days he's pessimistic and it's low. Sometimes when he's feeling fearful, even insultingly low. The thing is, you don't have to sell Mr. Market your shares at the price he's offering that day. You own a share of the most productive, most innovative companies from all across the world via your ETFs. So why would you suddenly be willing to sell them at a discount when you were happy to own and continue buying them at much higher prices just 20 days ago? This, of course, assumes you were planning to invest long term to begin with. Ask yourself what you're trying to accomplish. Is your primary goal capital preservation, or are you trying to maximize potential long-term returns? If your time horizon is only 1 to 3 years, for example because you're saving for a wedding or a large purchase like a house, then investing in the stock market is not the right place to put that money, as capital preservation is your top priority. However, if you're investing for the long run, meaning at least 5 years, ideally 10 years or more, then there is no reason why you should let these short-term fluctuations affect your strategy. Okay, but this time really feels like it's different. Whenever the market corrects, you'll hear people say that this time is different. During the 2008 financial crisis, many were saying that capitalism is dead. During COVID, people said things were never going back to normal. And in 2023, higher interest rates were going to completely wreck the stock market, and the list goes on and on. Just as we've seen in the past, there will always be a new reason to be worried and to sell. Now, what you could do instead is to see this period as a discount opportunity to accumulate more shares of great, highly profitable companies at a discounted price. Just think about it logically. If you don't need to touch what you currently own in ETFs in your brokerage account for a long period of time, why would you be sad about temporary market fluctuations to the downside while you're still investing regularly? Don't get me wrong. I do understand it can be hard to see your portfolio in the red during these periods, especially if you only started investing recently. Just don't let your emotions take over based on the latest news headline and keep your focus on your long-term financial goals. Looking at historical stock market data over decades may help you put things into perspective. Here's how my wife and I are approaching this. We're in a lucky position to be able to save and invest a combined 4,000 to 5,000 euros per month due to our comparatively high income and relatively low expenses. And just like we've done in the past when markets were down, like the bear market in 2022 or the scary COVID crash in 2020, we're going to continue sticking to our simple, globally diversified ETF strategy and buy a single ETF, the accumulating Invesco FTSE All-World, on a monthly basis. As much as it saddens me to see comments by some of you that seem disheartened by the current market correction, based on my own 8-year experience as an ETF investor, I'm kind of happy that I get to buy shares at lower prices right now. Okay, the one part I'm slightly annoyed with right now is that we don't have any cash to invest at the moment beyond what we already invested at the start of the month, as we're not touching our emergency fund on Trade Republic even when stocks are on sale. Alright, hopefully I was able to help you at least a little bit with this video. For me, it's important to not only show up when the market is going strong and to try and impress you with how great I'm doing as an investor, look at me, but also to be here during difficult periods like this when our own ETF portfolio is down almost 46,000 euros and when I see a growing number of Europeans struggling with and questioning their own long-term investment strategy. Remember, If history is any indication, this too shall pass. By the way, you can find my favorite low-cost brokers in Europe to buy ETFs down below in the description, which is a great way to support me as I don't do sponsors on this channel. And if you're wondering why I started buying Invesco's FTSE All-World instead of Vanguard's ETF, you need to watch this video right here, where I take a closer look at how Vanguard sadly does not seem to care about its European investors anymore compared to the US. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience so far. Thank you guys so much for watching. Have a wonderful day, and until next time.